US and the EU. You can throw Canada in there. You can throw Mexico in there. It appears as if this is all getting quite real, and global markets sitting up and taking notice. Let's find out what potentially this means going forward as far as trading stocks on the 200, and that is Chris Conway. He's joining us from the Australian Stock Report live from Melbourne. Chris, good to see you there. Weaker day for the 200 today. We're still, though, sitting at 6,199, above that 6,150 level. So how do we view this market technically?
Good afternoon, Nadine. I would say still viewing it bullishly, as you said, above the 6150 level, and that's really the critical swing point. As I said to you yesterday, if we slip back below that level, then we're really back to where we started of trying to get out of that range that had held us captive for quite some time. It's very nice to see the local bulls sort of fighting back today. Obviously had very weak leads from Wall Street. SPI futures were down north of 50 points. As I left for the studio, we were down about 15 or 16. So it's nice to see a bit of a decoupling from what's going on in the US and the US-China trade war narrative, which, let's face it, probably won't affect Australia as significantly as either of those two countries that are involved in the trade war. And it's nice to see that local investors are taking heed of that and, as I said, providing some support for the market.
Yeah, so, I know that we always keep an eye on the U.S. markets as well. There was significant selling in the U.S. I mean, pairing some of the losses late in the session. But you've got to be thinking that, the U.S. markets are sort of at a critical turning point. So how do you view the S&P 500? How do you view the Dow when we saw such widespread selling last night that encompassed the FANG stocks as well?
The Dow, I don't worry too much about, obviously, because it's a relic from a bygone era and it's not the best indicator of the breadth of the US market. But yeah, certainly the weakness in the S&P 500 and, as you say, in the FANGs, which previously had been exceptionally strong and had been a major contributor to the rally that US markets had seen. So yeah, look, I guess from a technical perspective, I'm much less bullish on, say, the S&P 500 as I would be on the S&P 200 here in Australia. But I don't know, there's some part of me that says I still don't think this trade war is going to do the damage that some are expecting. And that's because hopefully the players involved realise that it can't happen, because it'll take the world to a very, very bad place.
Well, we will have to see. I mean, nobody really knows where this is all going to end up. But as I mentioned, it certainly seems that with every ratcheting up of the rhetoric around trade, perhaps it's more difficult to come back from the precipice. Who knows? But, Chris, it would be oversimplifying things, wouldn't it, to say that stocks are only lower because of trade and this trade dispute that is emerging. So why else, in your view, are we seeing stocks come off?
It's a very good question, Nadine. Obviously, the trade war has been getting a lot of headlines, but as you say, there are other factors. So obviously transitioning from a quantitative easing environment to a quantitative tightening environment, as we see interest rates rising in the US most prominently, but in other parts of the world as well. There is, a perceived slowdown in China, and that's reflected in some yuan weakness as well. So not only are they fighting one side of that trade war that we're all talking about, but they have some issues of their own that they need to be dealing with. And there's also concerns about, on the other side of the trade war in the US, that we are approaching peak earnings, both from an economic perspective and an individual company perspective. So it seems like there's a narrative out there, aside from the trade war, that all the best that's going to be is behind us, and we're sort of starting to roll down the hill at a time when probably the global economy can least afford the trade war that we are all talking about as well.
But then, of course, it gets back to the 200. Why are we seeing this relative outperformance in the 200? Because there are signs that the Australian economy is not firing all cylinders. I mean, fundamentally, do you think that earnings in Australia are going to be supportive of this company moving higher in the second half of 2018?
I think they will be. I think we have a strong enough economic environment that we can continue from the last reporting season where, we do have better than expected earnings growth. But I think in more direct answer to the question that you just asked, Nadine, about why we've rallied recently, it's very simple. The banks have started to participate again. So from the April low up to 61.50, the market put on about 5 or 6%. The banks did absolutely nothing. And when I say nothing, I mean literally nothing, didn't contribute in any way, shape or form. As we know, they have rallied off the lows recently, and because of their sector weight and market weight, they have been the sector that has dragged us above that 61.50 level and has kept us going as well. Now, that's not sustainable, but I think that is absolutely the reason why we have seen this rally of late. But again, as I said, further out, I think we can have strong enough earnings that supports the market where it is at the moment.
So why on a day like today are we seeing, the likes of WiseTech Global, the worst performer? Is it because as well some of the small cap, not only that, but the high growth stocks are trading on such high PEs? I mean, does that make things a little bit more difficult for this market going forward?
Yeah, I think anytime you have, clearly bearish leads from Wall Street and a bit of a shock, I guess you'd say, from the moves overnight, it is those high PE names, those growth names that have really, really outperformed, like your A2s and your Bellamy's and some of the tech stocks like an Appen and things like that, that will get hit harder because that's the hot money, I guess, that retreats first. Again, not surprising to see the banks, probably the sector that's holding us up today or doing the best. But yeah, just in relation to those mid-caps, I think hot money will flow out of them first when things go awry.
Okay, now you've referenced the banks a few times. We haven't talked yet about the fact that the Bank of Queensland lifted its mortgage rates, really across all of its variable products, because they can no longer absorb the impact of rising funding costs on their net interest margins. So do you think that the other banks will fall in line, and I'm talking the big four banks? And if you're looking at this from a pure shareholder perspective, is that what you want to see?
It is a fantastic question, Nadine, and it's not one that I have the answer to. I would think in the current environment, what with the Royal Commission, an out of cycle rate hike from any of the big four would be absolutely pounced upon by the media and the court of public opinion. It's not to say that they won't do it, but I just find it very difficult that they would even try and bring more attention to themselves in an environment, as I said, where they're already copping a bit of a pasting. From a shareholder perspective, if I was a Bank of Queensland shareholder, then yeah, absolutely, I would support them doing this because it's going to, as you say, protect their net interest margins, and that's a big determination in whether the bank is, more profitable or less profitable than it has been in the previous 12 months. So, yeah, just from a shareholder perspective, I don't mind Bank of Queensland doing it, but for the big four, I really struggle to see how they'll do it, and I reckon some people will light some fires at the major banks if they try to do it.
We will see, because that bank bill swap rate, continuing to cost the banks money as it increases. So we've got the Bank of Queensland up at $10.37, up by 0.5% today, and the big four banks, we've got to say as well, doing well, up anywhere between 0.1% for Westpac and 1.2% for CBA. So given all that we've just discussed, what are you lightening your load of at this time, Chris Conway?
Sticking with the banking theme, Macquarie is one that we would be actively selling. So not only selling if we were holding long positions, but shorting as well. And look, I just need to couch this in the right way. Macquarie is a fantastic institution. They have done exceptionally well. They have deserved the management, all of the $125 share price that it topped out at recently. It's just from a valuation perspective, both versus its own historical valuation and against its Australian and global peers, it's expensive across every metric. So typically trades on about a 13.5 forward PE. It's up in the 15s now. Just to put it in perspective, if we look across to US companies that are similar, like a Goldman Sachs or a Morgan Stanley, the Macquarie share price has outperformed those companies by in the order of 35-40%, and are far more expensive across that forward PE metric and don't have as much active short interest as well. So, just taking that technical read and that technical data and translating into the fact that I think the gains from Macquarie are unsustainable, and we've already sort of started to see it for the share price pulling back into 120 from about 125. But I wouldn't be surprised to see if there was some further weakness, maybe back into about 110. But as I said, still a fantastic company. We don't think the momentum can be sustained.
All right, that's an interesting one. Well, I'm going to go right to a hold, because you're right. Yesterday we were chatting and you nominated BHP. Even given the cycle, and I suppose given what you've said about China slowing as well, you're still comfortable holding BHP. Perhaps given what's going on with the price of oil, I'm curious to get your thoughts on another of your holds, which is Qantas. Qantas has obviously done so well in returning to profit, paying dividends, return to that type scenario. Do you still see more upside in Qantas, or why would you hold?
Yeah, I certainly do see more upside in Qantas. I will say it's dependent on probably a couple of things moving forward, and it will come around August when they drop their results. So first and foremost, they're very likely to reinstate their dividend, could be in the order of 30 to 40 cents. I think that will be a positive catalyst for the stock, because it will attract some investors back to the register that haven't been there for the last 10 years because they haven't paid a dividend. So that's one potential positive catalyst. It's the more likely of the two that the second that I'm about to outline. But also an earnings beat is possible in August when they drop numbers as well. Now I think they need that if we're going to see a share price through $7. It's about $6.60 now. So if we're going to see significant further upside, which obviously is what I would like, then probably need to see an earnings beat as well. So yeah, back to your original question, I think I can be bullish on oil and still like Qantas, because there's a couple of other factors that I think will be more important to the share price moving forward, provided of course that they come to fruition.
All right, we'll leave it there. Chris Conway, Australian Stock Report, great to have you on as usual. Thank you.
Thanks, Nadine. Cheers.
So I guess we'll go back to the banking theme.